What's up, Cashflow Nation? I'm Jonathan, and today we're going to look at 3 of the top REITs to buy and hold right now in 2022. We're talking annual returns of up to 40% and market-beating dividend yields. Time is money, so let's get moving. We're going to jump right in with a very well-known industrial REIT before moving on to a couple lesser-known participants. Number 3 on our list is Stag Industrials Incorporated, ticker STAG. Stag is a high-quality business with a decade-long history of consistent growth. Over the last 10 years, this REIT has more than tripled its own square footage while growing revenue over 6 times and funds from operations over 8 times. The company's transformed from a smaller player into a major industrial REIT, generating strong returns for its shareholders. Stag is currently trading at $41.64 with a forward dividend yield of 3.48% and has the added benefit of being a monthly dividend payer. Its return to market doubling 38.5% over the last year and beats the S&P 500 in 5 and 10-year total returns as well, coming in at just under 125% over the last 5 years and a mind-blowing 484% over the last 10. Stag's portfolio has nearly 500 tenants, with Amazon the largest tenant, representing 3.8% of its annualized base rent, or ABR, as of Q3 2021, and no other tenant representing more than 1.1% of ABR. Its tenants are established operators, with over 83% having revenues over $100 million and around 32% being rated investment grade. During the pandemic, it recorded minimal collection losses, and I don't view the tenant base as risky given its solid diversification. This diversification provides protection against single tenant issues and geographic or industry downturns, while its presence in secondary markets encourages future growth. As the company's expanded its portfolio, it's maintained occupancy rates around 95% while steadily charging higher rents per square foot. Stag has built annual rent increases of 2 to 3% in most of its leases. Moving forward, annual escalators in the 2 to 3% range, combined with lower downtime between vacancies due to strong market demand, should provide a sustainable low single-digit base for growth in its existing properties. Additionally, management noted that recent retention has been significantly higher when adjusted for immediate lease-ups of newly vacant space. With nearly 60% of its current ABR up for renewal over the next 5 years, Stag should be able to renew or release its properties quickly and continue its historical cash flow growth. Stag maintains a strong balance sheet with around $740 million of liquidity as of the end of Q3 2021. It's conservatively leveraged at 4.8 times and maintains a meaningful cushion on all covenants. The company holds more than adequate liquidity to pay back all debt that comes due over the next few years and should be able to hit its stated acquisition volume targets. Overall, Stag's balance sheet remains a strength of the company and provides a platform to continue future acquisitions. Its valuation has creeped up over the last year as investors have recognized the quality of the company and begun to narrow the valuation gap between its peers. Currently, it trades at around 21 times trailing 12 months funds from operations and 24 times enterprise value EBITDA. For a REIT with a decade-long track record of consistent growth and the only pure-play industrial REIT with a presence across the entire domestic industrial market, this is a reasonable valuation. Over the long run, as Stag's portfolio matures and its rent profile reaches market levels, I anticipate dividend growth to resume levels previously seen from 2011 to 2015. Over this period, the annual dividend increased at around 17% per year. Next on our list of top REITs for 2022 brings us to Eckerdstadt Properties, ticker UBA. UBA is a shopping center REIT that's been around since 1969. Unlike some of its geographically diversified peers, UBA is concentrated in the metropolitan New York tri-state area outside the city of New York. UBA has the hallmarks of a family-run business that's been passed down through generations, as it's led by Chairman Charles Eckerdstadt and CEO Willing Biddle. There are many reasons to like UBA right now, one of them being its focus on necessity-anchored businesses. Currently, Eckerdstadt Biddle owns 80 properties covering over 5 million square feet of gross leasable area, and the company reports that 86% of this area is anchored by grocery stores, pharmacies, or wholesale clubs, and these businesses make up 29% of contractual revenue. 77% of UBA's tenants are deemed internet resistant, and 6 out of their top 10 tenants are necessity retailers. UBA currently trades at $19.16 with a forward dividend yield of 4.98%, paying out quarterly and has market-beating factor grades across the board. It has a 1-year total return of 39% after taking a pandemic hit in 2020. Prior to this, UBA had raised its dividend payout every year for over 25 years, albeit at a slow pace. Most shopping center REITs suspended their dividend during this time, and although UBA did cut its dividend, it never stopped paying. As of now, UBA's dividend is back to 85% of its pre-pandemic level, with a very comfortable fiscal 2021 payout ratio of 61% compared to its average of of 83% over the last 10 years. Yet another benefit is that the median household income in UBA's markets is about 65% higher than the national median household income and is among the highest of all retail REITs. Lots of affluent New York City residents moved into these areas during the pandemic. UBA has the second highest exposure to super zips as defined by zip codes in the 95th income percentile, sitting just behind Federal Realty Trust. This enables UBA to charge above average rents, ranking second among its peers in average base rent per square foot. UBA collected 94% of total contractual revenue for the period from April of 2020 through October of 2021. Only 4.5% of rent was abated during this period, showing a strong performance even during the pandemic. Eckerdstadt is a high-quality shopping center REIT that's executing very well, with improving occupancy and rental rates. It collected the vast majority of its rents this year, and the trend should continue as demand for its properties pick up. UBA maintains a very strong balance sheet and has the highest dividend yield in the shopping center space. It remains attractively valued compared to its other high-quality peers. And last but certainly not least, we hit up the diversified REIT industry with Alpine Income Property Trust, ticker PINE. Alpine is a newer net lease REIT that went public in 2019 and specializes in owning, acquiring, and operating high-quality commercial income single-tenant net lease properties. Pine has 113 properties within 32 states and just over 3.2 million square feet of lease space. Alpine Income has a market cap of $243 million, making it the smallest on our list today, but it also makes it the most agile. And 100% of the analysts covering Pine give it a buy or outperform rating. Pine currently trades at $19.12 with an attractive forward dividend yield of 5.63%, paying quarterly. It has a one-year total return of just under 22% versus 18% for the S&P 500. It increased its dividend 23% over the course of 2021 while collecting 100% of its base rent and maintaining 100% occupancy. And to add a little icing to the cake, it increased acquisitions at a blistering rate throughout the year, focusing on high-quality net lease properties with a strong focus on industry-leading tenants. Portfolio growth is up over 250% since its inception just a few years ago. Its top tenants include Wells Fargo, Walmart, Lowe's, and Walgreens, with the top 10 making up 48% of its portfolio. Its dividend is better than the average of its peers and is strongly supported by a conservative payout ratio of 68%, further demonstrating its ability to continue to pay both dividends and raise them in the coming quarters. Pine trades at a 4.6 times valuation discount to the industry average, implying significant upside, and analysts have an average price target of $22.36, giving us a potential 17% upside, not including dividends. One thing that really interests me about Alpine is that because of its small size, it isn't competing with the net lease industry's larger players. It can take the time to find and buy small one-off properties that can give a significant boost to its top and bottom lines. The competition for these properties tends to be local private investors who don't have the same access to capital as a publicly traded REIT. That gives Alpine a leg up as it builds its portfolio and means that it's really working in a completely different market segment from giants like WP Carey and Realty Income. Alpine also doesn't have legacy assets in markets that may be mature or experiencing weakness from local economic decline or falling population. It can literally focus on markets that are strong today. In fact, nearly half of its rent come from high-growth states, including Texas, Florida, and Arizona. I see Alpine Income Property Trust as a way to add some growth to your net lease exposure, getting some benefit from the REIT's small size, the market test it endured in 2020, and that it occupies a different niche than the giant net lease REITs I own. It offers that attractive 5.6% dividend yield that's already backed by 4 increases in a relatively short period of time, and it's priced at a discount compared to bigger players, largely thanks to its small size and brief track record. So, both value and income investors might want to take a look. If today's video helped you out in any way, pop that like button and subscribe to join the Cashflow Nation. I'd also love it if you dropped a comment below and let me know what REITs you may be looking at right now. Thanks and see you next time.